Hello and welcome to the weekly energy market update. My name's Jitesh and I'm a market analyst and energy trader at Trident Utilities. Today I'll be giving an update on last week's energy market activity and highlighting the key price drivers. So starting off with the gas market, the NBP June 20 contract lost 0.94 pence per therm as losses in the first half of the week proved too great to recover. This was attributed to length in the national transmission system, which pressured prices in the week. Further down the curve, the Winter 20 contract remained flat, whilst the Summer 21 contract traded higher by 0.5 pence per therm, steepening the contango. The week started with temperatures at 4 degrees below seasonal average. Front-month LNG traded around the $2 mark, as LNG storage in the UK nears 65% full, much higher than the 5-year average at 37% for this time of year. Now this signals healthy supply in addition to the EU storage levels sitting at 67% as injections have ramped up. From Wednesday onwards, demand increased to above seasonal average, including planned and unplanned outages in Norway, adding 50 mcm of risk to the prompt supply as flows into Easington were impacted. As of Friday, there are now 6 LNG vessels headed towards the UK by the 26th of May. IEA have said global natural gas demand is on track to drop by a record 5% in 2020 due to the economic impacts of COVID-19. So moving on to the power markets. The front month baseload lost 0.42 pounds per megawatt hour over the week. However, the seasonal baseload contracts were stronger as Winter 20 and Summer 21 contracts gained 0.12 and 0.37 pounds per megawatt hour respectively. The first half of the week shed losses along the curve due to the strong renewable output at 53% and EDF Energy postponing planned outages for 30 of its 58 nuclear reactors by up to 16 weeks, which also supported the carbon market. Prices over the latter half of the week was supported by higher gas for power demand, reaching 8.7 gigawatts on Thursday, lower wind output and strong exports. Despite the volatility in the renewable output, it dominated the generation mix, contributing 52% over the week, whereas CCGT contributed 21% over the week. Nuclear output decreased to 18.38% over the week, as Sizewell B is helping the national grid cope with demand reduction. As the UK lockdowns are set to ease, with some shops to open by August, this gave bullish momentum to the Winter 20 and Summer 21 contracts. So moving on to the oil market. So we saw similar price patterns in the oil market as Brent traded lower in the first half of the week, shrugging off Saudi Arabia's additional 1 million barrel per day cut due to the coronavirus outbreaks in China and South Korea. However, by midweek, the market sentiment changed, helped by the EIA reporting a 745,000 barrel drawdown in the US crude inventories. Obviously, this is signs of recovery as demand from refinery runs are increasing from 15-month lows in China and falling US production. Brent eventually settled at $32.5 per barrel, up 5.86% on the week. The IEA have forecasted consumption for Q2 at 79 million barrels per day, which is 20 million barrels per day lower than levels last year. Demand forecast for the whole of 2020 is at 8.6 million barrels per day, 9% lower year on year. On the supply side, the world oil production is on track for a historic decline this month to the lowest levels in 9 years. Global oil supplies are poised to plummet by 12 million barrels per day, or 12% this month compared to April. This is because OPEC and its partners are slashing output, while others like US are forced to scale back drilling as the market proves low prices are not viable for any producer. The US oil rigs continue to fall to record lows of 339, which was reported on Friday. The EIA have also reported Brent will average $34 per barrel in 2020 and $48 per barrel in 2021, as supply-side pressures are still expected to weigh. So moving on to the carbon market, we saw carbon lose value by 0.33 euros per tonne this week, following a similar pattern to gas, power and oil, as it traded down to 18.52 euros per tonne on Wednesday. However, for the rest of the week, it was rallying, settling on a bullish note at 19.17 euros per tonne, which could obviously continue into this week. So thank you for listening. I look forward to next week to report on this week's activity. And please visit our website to find our weekly energy reports. Thank you.